Despite considerable market volatility, driven by Trump's trade policy, future Fed cuts, geopolitical tensions in the Middle East, just to name a few, equities continue to rise higher, with the S&P 500 and NASDAQ reaching all-time highs this last month. So what do you believe is fueling the market strength?
Christina, it's a prescient question. And those viewers that know us will know when it comes to predicting the future or interpreting short-term market fluctuations, we tend to say the crystal ball is foggy at best. I will say this though. If somebody had come to me in January and told me, one, the war in Ukraine will continue to wage on. Second, the Trump administration will start a global trade war, alienating allies all over the world. Third, the US bombing nuclear facilities in Iran. And fourth, throughout all of this, the Fed not cutting interest rates. I would have not predicted that US markets are up year to date. Now, it's probably a combination of the AI euphoria going on. Keep in mind, the four hyperscalers combined are spending about $600 billion in CapEx this year. Then the US economy continues to perform quite strongly, although we are seeing some deterioration in sentiment. And lastly, I think there's some complacency in the market about the looming tariff disruptions. There's sort of a sentiment of the can will be continuously kicked down the road. Now, importantly, the one prediction I think I would have gotten correct is that against this backdrop, our style of investing, which focuses on resilience, performed very well against the S&P and against the NASDAQ in this environment of heightened uncertainty.
Now, you mentioned our style of investing. What risks or opportunities do you see arising from the latest US tariff proposals?
So the 90-day extension is expiring today as we sit here. And if I'm counting correctly, we've had less than a handful of pretty vague agreements signed so far. And I think people seem to forget that as things stand today, the tariff rate will be in the low to mid-teens. That's the highest in 80 years, and it's awfully close to the smooth holidays. And being students of history here at First Eagle, we know that this wasn't a pretty period. So what does it mean in the context of global investing? You know, there's the saying that happiness is reality divided by expectations. And when I look at credit spreads or valuations as a proxy for expectations today, expectations in the US remain very elevated. But once you leave the US, expectations are a lot more moderate. And not only are expectations a lot more moderate, I think at the margin, things are getting better internationally. Germany is engaging in some fiscal stimulus. Europe and Japan are increasing the defense spending. That should lead to some nominal growth. And in China, Xi Jinping has sort of acknowledged that private enterprise is important, and he has rehabilitated the tech sector. But we're bottom-up investors investing in equities. And I think the best protection one can get bottom-up is investing in businesses that have few substitutes, businesses that don't really have any competitors, only few competitors, because that allows them to have some pricing power. And what that means is any sort of tariff-related costs can be passed on to the end consumers, and those businesses don't experience the margin squeeze. So owning a global portfolio of those kind of businesses at attractive valuation intuitively makes a lot of sense to me within this uncertain environment.
Great. Thanks, Christian.